afternoon, student. Can you all hear me? Can you all hear me and can you all see my screen or not? Hi, everyone. Anyone can respond? All right. So attendance here today is not so good. Okay. So only 20, 21. Okay. All right. Later I will double check the attendance. Okay. So let's start tutorial 5. Okay, question 1, examine the differences between short terms and long-term finance. Okay, anyone can describe or can give your opinion. What is the differences between short terms and long-term finance? Anyone? What is the differences between short terms or long-term finance? Any difference between them? How would you like to answer if this question come out short terms and long term? What is the differences? Short term only for okay. First short terms, Chui say finance for working capital. Okay, maybe Chui can further elaborate. Okay, working capital means what? For what purpose? It's actually for what? Normally they get the finance as a working capital, so that is for what purpose leh? Okay, so actually you can see that they actually get the funding to fund for development project throughout the development period, total development period. Okay, makes sense? Some more? Anyone? Others? Others like tester? Okay. May Yi answer? Tester seed. Ng Mei Yi. Answer please. Short term is liquid, where long term is liquid. Okay, good. This one will be not advisable to talk like that lah, because this is more like funding rather than investment. Okay, so short term would cannot is actually correct. The concept is correct, but then the way you liquid or illiquid, it will be more suitable to elaborate the investment nature rather than the funding. Okay. Is maybe I think short term, short period, long period would be more suitable than liquid and illiquid lah, because this is not investment. Okay. Tester, Mei Yi, Ng Mei Yi, are you all there? If you are not there, then I will mark your attendance as not counted. Wow, I call other person, then another person answer me. Short-term payment predictable. Short-term, yes, correct. Predictable. This one may be more suitable later for the funder. Okay, wait. Chui Yi say okay, correct. More suitable for merchant developer. Good. So, Chui Yi further elaborate. What does it mean by merchant developer? Long-term held okay. Long-term normally will be the working capital itself plus until the end, not to say the end, until retaining the project as an investment to enjoy stream of income, correct? Yes, correct. So answer for merchant developer, their nature is they don't like to hold it. They don't like to keep the property. After they construct, more likely they want to dispose to third party Okay, so their intention is just to construct the building, earn the profit, then run away. So this is what we say merchant developer. Yes, correct. No intention to keep. So there are some developer, they just wish to construct land, and after that they sell to third party. So they don't have the intention to maintain the building itself. Because if you want to retain the building, that is a quite tedious job to do. That is the consequences. But the pro is you can enjoy the stream of income. So for short term will be more suitable to merchant developer, and for long term will be more suitable for investor developer, which means that it's opposite lah. This developer they would like normally they would like to retain to keep the property in long term, so their intention is to enjoy the stream of income. Okay, then why okay, maybe my question like this for long-term funder, for long-term developer, the investor developer, why they want to get the funding until the end leh? They can just stop at development period ma. Why they need funding after the work period, which means that during the occupation period, finding the tenant, why they need funding during that period leh? Is there any reason why they need to take mortgage long-term fund at the end? Because unable to sell. Yeah, there is a uncertainty in the future lah. So once they complete the project already, perhaps they cannot get 100% occupancy. That is a risk because you cannot expect once you construct, surely every lot, every retail unit or every unit you can actually sell to or rent to all the tenant. There is a tendency might not have tenant. So that is a risk law. In order to cover the risk, most likely they will actually take long-term mortgage in the future to cover the uncertainty period. So that's why this is what we call mortgage until they get stabilized income. Until stabilized already, then only they will quit the funding. Don't need to take the funding anymore. But then because at the beginning there are many uncertainty, they cannot so sure whether they can get 100% tenant or not. Because when no tenant means no income, you cannot serve the loan. So that is a reason why they want to take the funding at the end. Okay, so basically that is the differences between short term and long term. Okay, all right, so moving forward, what is the difference between debt finance and equity finance? What is the difference between equity and debt finance? Answer please. We start from debt finance first. What does it mean by debt finance? What does it mean by debt finance? Normally, the developer will do what? Okay. Oh, Dexter, finally you appear. Borrower developer issue bond. Hong Lam remind me something. You have to remember who is borrower, who is funder, because I really got students will confuse. So in this case, borrower is the developer. Okay, so they need to borrow to raise a fund. Okay, how come Jasper you are here? Okay, so I would say company or borrower or developer will issue debt, or sometimes we call it what? Loan to raise fund. That is a proper way to answer. Remember, as I mentioned in the class before, the way you answer for property investment versus funding should be different. So in this chapter, development funding, you should always talk from the developer perspective. You cannot talk the investor perspective. So you cannot keep on saying, someone buy the loan, buy the bond, get the interest, then they get back the initial investment, less risky for them. This is correct. But then, if the topic come from funder, development finance, then you are wrong already. Okay, so be careful. The way you answer for development finance should be different from investment that topic. If the question come from investment topic, then you talk from investor perspective. So remember this point, very, very important. So Hong Lam and Jasper, the way the answer is correct, they will issue, I wouldn't say bond. Bond is one of the example. Debt or loan to raise fund. So that is a common definition. Okay. Then normally, which means that you can say borrow from third party. Get the funding, raise the fund, okay, get the loan or debt from the third party. So now we are talking about, just now tester say obligation. What are the obligation of the developer? First one is contractual repayment. What does it mean, tester? What does it mean by contractual repayment? Can you further elaborate? Your coursemate may not understand what does it mean by contractual repayment. Dexter, can you further elaborate? Okay. Don't advisable say coupon rate. In this case, preferable say interest rate. So the first is pay interest rate to the funder. So this is normally fixed law. Okay, I would say this is the regularly. So which means that they need to pay the interest rate normally fixed between the two parties regularly, which means that depends either per month or per year to the funder. So that is the first commitment, obligation, or sometimes we call commitment also can. All right, so first is they pay the interest rate. Not advisable say coupon rate, because in this debt, bond is one of the example of debt. Debt is the mother. Okay, bond, the bond is the children, one of the example. So preferable to say pay interest rate. Okay, then contractual repayment is you need to repay back the initial payment to the funder. So which means that at the end of the day, like Dexter say, you borrow how much, you need to repay that figure to the funder. That is a contractual obligation. Okay, no matter the company developer make any profit or didn't make any profit, they need to settle the debt first. So which means that pay interest plus they need to settle the repayment back at the end of the day. Okay, so how about the risk part? Debt finance is risky or not risky for the developer? Risky or not risky, or low risk? Okay, less risky lah. Why leh? Why? Why? Why we say that this financing is less risky to the developer? Why leh? Is there any reason? Okay, good. Carry no ownership. This one have to be careful. So the funder carry no ownership. So they don't have decision making law, which means that Ting is right. Developer will retain the control. Or you can elaborate like there is no direct relationship or link between the funder and the company investment. Okay, I repeat again. why we say less risky to the developer is first, the funder carry no ownership, which means that there is no direct link or relationship between the funder and the developer investment, which means they cannot kacau. They cannot say, hey, don't invest this one, that one. So they don't have any voice of, they do not have decision making. So in that sense means developer retain control, the power. Or you can say the funder, not the funder, the lender or the funder cannot intervene, cannot disturb the company operation. Okay? All right. Some more, this one less risky. Still remember or not, when we say loan, when we say debt, there are how many types of the loan? How many types? How many types? Remember or not? Yes, okay. Generally divided into secure and unsecured loan. Okay, maybe Xingting can explain or not. What does it mean by secure loan? Or any one of you can help Xingting. What is secure? What is unsecured loan based on your understanding? A developer can raise either secure loan or unsecured loan. What is the difference between these two? Can anyone or Xingting? Secure got collateral. Okay. Then unsecured means? Okay, I will talk about secure first. Secure loan, which means that during the agreement, the developer will pledge the collateral as a form of security. So the collateral can be in the form of property, can be in the form of plant and machinery, normally asset valuable asset, or maybe share. Share also can be one form of the collateral. So which means that if the developer bankrupt, cannot pay back anything, then the asset the property, the share will belong to the funder. So this is more secure because sometimes you also worry that when you borrow one big sum money to another person, the person cannot commit, cannot pay, isn't it? Or they run away or whatsoever reason. So secure loan is more secure, backed by asset. This is what we call collateral. Unsecured DH is what? Based on, okay, unsecured loan, correct, which means that there is no backed by any collateral, which means that sometimes the bank, let's say I'm saying the bank will lend the money because of the company background and their reputation is very good. Okay, so which means that in this form of the borrowing, there is no collateral. Okay, so based on trust, based on the company background and reputation. So which means in this arrangement, no need have any asset to be pledged. Okay, very good, Xingting. Okay, now talk about example. What are the example under issue debt or loan? When we say issue debt, issue loan, what are the example? Now we are talking about the children. Okay? Oh, come on, this fellow is who? Why gives this place? Manjun, come answer. What is the example of debt finance? Lee Manjun, answer please. What are the example of debt finance? They can issue loan means they can issue what? Wait, faster later 2 o'clock I got class Can anyone answer? Manjun, are you there? They can issue what to raise fund? Debt is the mother. Now we are talking about the children. What are the example of debt finance. Okay, bond, correct. Some more. Bank loan, okay, loan can no. Bank loan can be one of it. Share, are you sure, Manjun? Want to slap you already. Share, are you sure? This is debt finance. We are in different channel already, Manjun. Bank loan, bond, some more. What are the example? Correct. Debenture is one of it. So for your information, bond and debenture, they are quite similar. Just that debenture more high risk. So the rate, the coupon rate tend to be higher as compared to bond. But then they are the same lah. Okay. Some more? Still got or not? Okay, loan stop is correct. Remember, loan stop, although the word stop here refer to share, but loan stock is one form of secure loan. They use share as a form of collateral. So that's why we call it loan stock. So take note, loan stock is debt finance, which means that they use share as one form of the collateral. Okay? All right. Okay, come back here. Equity. Equity, what is equity finance? Anyone? What is equity finance? Means company will issue. I believe I mentioned before there are a few definitions here. 3 definitions to define equity finance. So what are the definitions? First, correct, company, or in this case we will say developer issue share in public to raise fund. Some more. When we say equity finance, what are the others definition? Yes, JV, which means that investment or from others. Okay, preferable JV lah, joint venture. Yes, Mei, correct. Company own resources or capital or fund. Okay, so remember, don't limit yourself when we say equity finance, only means that issue share. That is one of the definition. The second is partnership. Okay, JV, joint venture with other party, which means that you also share the equity from the third party. You take let's say I JV with Jasper, I will take the money from Jasper, combine with my money to kickstart a project. So that is also considered as equity. Or the company own capital and resources, that is also one form of the equity finance. Okay? All right. So any obligation or commitment, when we talk about issue share, okay, now we talk about this one, issue share, we focus on about this one. Any commitment or not to the funder, to the investor? When the company decided to issue share, yes, they had to pay dividend, but then this is not what? Not contractual obligation. So which means that it depends on the company performance. If they can perform very well, then they had to pay the dividend. So this is not fixed. This is not a must they have to pay. But then generally, they need to pay the dividend. Okay, that is the first obligation. Then remember, for this one, you no need to repay back. No need to repay back the initial to the investor. Okay, share profit and risk together. This one will be applicable for JV. Okay, if you invite third party to become your partner, as I mentioned before, then you have to share profit, share the risk together. And then remember, when you consider this option, JV, now I'm talking about JV. When you want to consider JV, you have to make sure there is what? Sufficient surplus to share. Then sufficient communication is very important, as I mentioned before. Okay, so that is number 2. The risk and the sharing things have to discuss well. Okay, and then for the first one, issue share, you need to pay dividend, but then that is not contractual obligation. And then the second one is no need to repay back the money back to the funder. Okay, then maybe I ask you like this. What if the company cannot perform? Meaning to say that in the case of issue share, cannot perform, then tell you, oh, no dividend this year lah, no dividend next year. What will happen? What will happen if the developer keeps saying no dividend, okay, company didn't perform very well? What is the consequences when we doing this kind of financing? Any consequences? If they say that no dividend, cannot perform very well, if you are the investor, yes, first, when they keep on saying no dividend, okay, not performing very well, there is a risk that the investor, the shareholder will what? Pull out quick. Because who want to keep on investing if the company no pay dividend okay, didn't do this kind of thing no confidence, isn't it? So that's why shareholder will lose confidence. Yes, the value of the stock will decrease. They will what? Pull out. So when they pull out, which means that less funding available to the developer, because the issue share is they want to get funding from you But then if you quit because of losing the confidence, which means that no more funding, less funding flow to the developer already. So that is a bad thing, Okay, so this is the thing that you need to put into the discussion as well. Okay, so here again, we all know that this will be high risky financing to the developer. Okay, why? Why we say this form of the financing is high risk to the developer itself? Why? Yes, shareholder have the ownership. I would prefer you all say developer lost the ownership. Okay, so as I told you just now, it would be better that you always start your sentence from the developer, because I worry you all got a habit always start from the shareholder, the investor. So for this topic, it would be better you always start the sentence from the developer point of view. So developer will lose the ownership because they are giving up the ownership to the shareholder. So ownership means what? Control. So their share will dilute, means will the loss control over a long term if they keep on issuing share to the public. So that's why you can see that when for a developer, normally they will mix these two together. They will issue debt, they will issue equity also, but then the debt will higher percentage rather than the equity, because equity high risk financing and they are giving up the ownership. So actually it's quite bad for the company, which means that they will lose the control to the third party. Okay, so that is the explanation. Ownership to third party. Okay, so what are the examples when we say share? Issue share. Share can be divided into what? as I showed you before in the lecture slide, most of the developer, they will issue what? What are the example of equity finance under category of share? Anyone? What are the example of share? Issue share means they can issue what? Okay, right issue, some more. Right issue, and they can also issue new share, not share, new share. And last one is what? What is the name already? The last one is what? Last one is what? Retain earning. You see, I myself also forget sometimes. Luckily, open book or class. Okay. These three, anyone want me to explain again or not? I ask you all again. These three, which one you not clear and you want me to explain again? Before, I think I already explained very detailed in the class. Anyone still don't understand and you want me to further explain again the differences? Okay, no reply, then I move on. Okay. Right issue. Okay. Right issue means they will issue the share to the existing shareholder only. As compared to new share, means new share normally is to the public. Anyone can buy. New shareholder or existing shareholder, they can buy. But right issue normally to the existing shareholder, and some more they will issue at lower price. Maybe class, anyone can tell me, tell Derek and tell me why they want to issue to existing shareholder and some more at lower price Kenapa? Why? Why they want to issue to existing shareholder only? Some more at lower discounted share price. Get more funding. They can also get more funding from new share fast money. Okay, that is a word. First, some company might have difficulty to attract new and fresh shareholder because not every company very well known and their share price very attractive correct or not? So in some cases, some of the company might choose issue right issue target existing shareholder to get more funding. Okay, that is the first reason. The second reason is is what sometimes they need to have quick money, so it will be easier to get it from the existing shareholder rather than the new shareholder. So that is a meaning of right issue. Okay, so it depends on the situation. Some they will issue new share, some they might choose to issue right issue. Okay, so that is a definition of right issue. Okay. All right. Now, what is the differences between project funding, corporate and project finance? We go for corporate first. What is corporate finance? What is corporate finance? Company raise fund based on what? Yes. Raise fund based on company itself. So for this one will be more rely on the credibility or strength, correct, of the company. So that is the meaning of corporate finance. They can raise a fund through the company profile, credibility, the strength, the reputation of the company. Okay, so under this category, they can have also equity finance and also the debt finance. Okay, before I talk about this one, maybe I go for project finance first. Then project finance, what does it mean by project finance? Raise fund based on what? Yes, raise fund on an individual development project. Okay, so for this one, different is there will be more rely on the quality or viability of the project rather than the company. So for this one, right, it does not mean that they won't evaluate the company profile. They still will evaluate, just that the focus, the heavy weightage they will place on the quality, viability of the project, which means that they will check how much is this project return, any pre-let, any anchor tenant, and so on. So the more heavy weightage they will place on the project, the viability of the project rather than the company profile lah. Okay, so under both finance, they can either raise equity and debt finance. Okay, so you have to remember corporate, how they can raise equity finance is, as we mentioned just now, they can issue share. So can be new share, right issue, and also the retained earning. So that is the equity finance under the corporate finance. And then the debt finance, we also discussed just now, it can be loan, it can be a bond, it can be debenture, it can be loan stock also. Okay, so for this one, will be classified under the corporate finance. Okay. Then now, if we talk about project finance, what is the project finance under the equity? How equity finance can be raised for the project? Normally, they will do what? How they can raise equity finance? Yes, very common, as I show you in the lecture slide, a lot of them, they will do what? JV lo, joint venture. Okay, now maybe anyone can tell me why joint venture for a project? Any benefit? What are the benefits when joint venture with another party? What are the benefits can a developer get? Can a local company get? Share risk, that is the first one. Yes, share risk, share job, share task. Okay, share knowledge, share new technology and expertise. As I show you a lot of news in this chapter. So some of the company they JV with China, they JV with Japan because of their expertise. So JV, although not good if you want to share profit, but the good thing is you can share the risk, okay, share the tasks together to complete the project, and also share the expertise. So that are the benefits of JV lor. Very good. Some more, and also share fund, share money also, because sometimes they might not have sufficient money to kickstart a project so they also share the funding together lor. So initially, that is the reason why sometimes let's say when you let's say who Manjun. Manjun, I think is a guy if I'm not mistaken, Manjun is a guy. So Manjun graduated already. He want to buy a house, but then like not sufficient money. So JV lo, JV with who? Your girlfriend your mother lah. Oh yes, you're a guy. Okay, so Manjun, my opinion is you can JV with your girlfriend to share the risk together, share the capital together lor. So 50-50 rather than you give out 100% So JV has a benefit to share fund also. Okay. All right. How about debt finance? What are the example of debt finance under the project finance? Normally, they can get what? To kickstart a project. Yes, can get any form of the loan lah. Okay, loan from bank, from insurance company, or from any other financial institution. Okay, so not limit to bank only. It can be from insurance company, from financial institution, as long as they get the money. Okay, so it could be any loan, any short-term borrowing from others party. Okay, so now question time. Okay, let's imagine imagine now the developer divided into big and medium and small size of the company. So big size, medium size, small size. So now question is, for corporate finance, what do you think? Who will suitable to get corporate finance? Big, medium, small. Maybe I talk about big first. We talk about big first. What do you think? Big company can get corporate or not? Can get corporate finance or not? Can get project finance or not? Okay, my question again. Sorry. For big company, can get corporate finance or project finance or both? What do you think? For big company like Sunway, SP Satir, EcoWorld, can they get corporate finance? Can they get project finance or both? Okay, so most of you say both lor. So yes, big. So we know that for big company, corporate finance definitely no issue lah, because they got, unless they are not listed lah, but most of the time they are listed, then they can issue share lor. Then normally they can, no problem, definitely can get debt finance. And for big company, no issue, because for project finance, normally place more on the quality of the project rather than the company lor. So for big company, no issue. Corporate and project, no problem. Okay, now go to the small first. What do you think, small company leh? For small company, what do you think? Corporate, project, or both? Corporate, project, or both leh, for small company? In your opinion? Okay, so most of you say project. Okay, why? Now always must know how to justify. Everybody will have their own opinion one, definitely. So for open question, you must always know how to justify. Why leh? Why you all say project finance? Hey, how come I write project? Why project finance only? Why can't they get corporate finance for small company? Why you all vote for project finance? Any reason and justification? Kenapa? Okay. One of the reason is small company, their credibility might not be so strong. So they might not so well known. And some more, most of the time, small company, they are not listed. So they cannot issue equity finance, correct or not? And then for debt finance here, for this one, right? It's a yes or no, but most likely it's no lah, because of their financial is not so strong as compared to the big company. So most of the time they cannot get corporate finance. That is the first reason. So the only choice is the project finance. Why? Because project finance will be more reliant on the quality, as I say just now, the viability of the project itself rather than the company. So for this one, if the project is good, then no matter you are big, medium, small company, as long as the project is good, pre-let already, got anchor tenant, then shouldn't be any problem. You can get project finance, either you JV, either you get loan from the financial institution. Okay? Then how about medium leh? What do you think? How about medium? How about medium company? How about medium company leh? What do you think? Corporate, project, or both leh? Both. Okay. You say both are medium. Medium. Okay. So for project, we talk about project first. As I say just now, they more rely on the quality and viability of the project. So no matter you are big, medium, small size of the company, no problem. As long as the project is good. So for project finance, normally big, medium, small, it does not matter. Okay. But for corporate finance is medium company is at the gray area. That's why you see I put the color gray area. It's a yes or no. Okay. For medium company, if the company listed, then they can raise equity finance. But if the company is not listed, then definitely they cannot raise equity finance though. Then for debt finance also is a yes or no. Okay, they can either raise secure, is secure loan. Okay, but for big company, secure and unsecure. Can you see the difference or not? Okay, for big company, definitely can raise secure and unsecured loan because they are well known But for medium company, most likely they can only raise secure loan rather than unsecured loan. So for a very good answer, you must always know how to give what to say in a very good, when answering a question, the good answer is you must always know how to provide a scenario because the future is not certain. So you must always advise your client, what if A scenario, what if B scenario. Assuming medium company is not listed, then they cannot raise equity finance. But if they are listed, definitely no problem for equity finance. But then for debt finance, if the company, medium company, not so strong, so most likely they can only raise secure loan rather than unsecured loan. But for big company, definitely no issue. Both secure, unsecure should be no problem. Okay, so that's it for this one. Wow, 1:30 already faster Who are the I think I go to question 3 first, faster. Okay, faster tell me financial arrangement and structure available. Faster, later cannot finish. What are the financial structure available? What are the financial arrangement? Okay, forward funding. Okay, faster, Lisa. Some more? Rent sharing. Yeah, some more. Some more? Okay, project management fee. Okay, 还有吗？ Some more? Sales and lease back. Okay, some more? Clawback arrangement. Still got or not? I think still got one more, right? 1, 2, 3, 4, 5, 6 number. Last one. Yes. Okay. Profit sharing. Due diligence. Wait, since when I teach due diligence under the financial structure Hong Lam? Ayo, don't scare me Okay, out of these 6 out of these 6 arrangement, right? I'm not going to elaborate again, but of course, I will ask you all which one you don't really understand or not clear and you want me to explain again. Huh? Which one Which financial structure you feel that don't understand and you want me to further elaborate again out of these 6? Understand or don't understand? Depends clawback is this one Derek. Okay, Derek, I guess you want me to explain this one clawback some more? Others okay If okay, I move on Okay, I will go to clawback. Okay, for clawback arrangement, right, is only suitable for between the developer and the landowner. Okay, landowner. So it's very normally the landowner, okay, the landowner will dispose. Can you see this one? Dispose the land before the developer obtain the planning consent. We all know that planning consent will take time consuming. So perhaps it will take several months, who knows, correct or not? So normally in this case, that the landowner A will dispose the land to the developer before get the planning consent. So let's say now is June 2021. Dispose already. So the land value is, let's say 500,000. So ding ding dong dong, the planning consent will take half year. Half year. So let's say January 2022. Who knows in between these 6 months, the land cost increased to 510K. Say for example, during these 6 months, there is a possibility the land cost increased to 510K. If they enter into clawback arrangement before landowner sell, then developer has to pay the uplift cost if the future cost increase after obtain the planning consent. So which means that they have to pay this value. The uplift is 10K. Provided they enter into this clawback arrangement. So which means that before the landowner sell to the developer, they have to come into an agreement saying that, hey, Mr. Developer, okay, now if the land price increase once you get the planning consent, I want to get back the uplift. So it depends on the developer whether one or the one. Okay, so this is the clawback arrangement allowing the developer to pay the uplift cost if the land cost increase in the future. Okay, so Derek, okay or not? Derek, understand? Why no response one, Derek? Lost already are you? So for normally remember you see this picture I purposely illustrate myself to give as an explanation to you, because I always think that a picture spell 1,000 words. Okay, so that's why I always use picture to illustrate some of the sentences. But if let's say in the final assessment or in any question, right, please do not draw back the similar figure to me. Okay, I prefer wording only, sentences only. Please do not reproduce the same figure to me, because this figure from me so if you draw back again, it's like meaningless. Don't waste your time to sketch any figure. Okay, just focus on your elaboration. Okay, this one is I purposely illustrate to give better explanation to you all. So please do not reproduce back to me in the final assessment, say for example. Okay, All right. Any others? No more idea. I will go on. I will go to the question 2. If no more, everybody okay? All right. Then I go to question 2. Who are funders that are interested in property investment? Okay, maybe I change the question. Who are long-term funder? When we say long-term funder, who are long-term funder? Okay, pension fund, EPF. Some more. Yes, life insurance company. So for short term, normally I will classify them as a general insurance. No? And banks sometimes, most likely they are short-term funder. Then you all still remember or not why we say EPF, life insurance, they are long-term funder leh? Why leh? Why we say they are long-term funder? Based on their what? Remember or not? Based on their what? Why we say EPF, life insurance, they are long-term funded? Yes, liability. Correct. Very good. So I will explain back this figure just in case you don't really understand. Okay. Why we classify them as the long-term funder is because of this one. First one here. The liability. Okay. Say for example, EPF ma. So EPF, we all know that once you graduated already, let's say 25 years old, you need to start working. And when you are working, you need to contribute your money to EPF as a saving. So you're 25 years old, you start to save to EPF. Only at age 60 years old, you can withdraw all money back. So you can see 60 years old to 25 years old, this is a big gap. It's approximate 35 years. So this 35 years is very long term. So EPF foresee that you won't withdraw your money so soon. So that's why their liability is very long term. In terms of payment compensation, which means that how soon, at what age you want to withdraw the money, they can predict. 60 years old ma, so they can predict at 60 years old, you need to withdraw back all your money. So in terms of the payment compensation timing is predictable, or sometimes we say the timing is certain. They know you won't so soon withdraw money, especially lump sum money. I'm talking about lump sum money. So since the payment timing, the compensation timing is very predictable, then in terms of the choice of the investment, most likely they will invest in long term more than the short term, because long term investments such as bond, property, they are illiquid. And then for short term investment like share, REITs, they are quite liquid. So remember, liquidity means how fast, how soon you can withdraw the money. So because quite long term 35 years so it's quite suitable to invest in property, because property is a long term investment. It does not mean today you buy the property, next year the property price increase. You need to buy and hold your investment. It's not like share price, because share price is very fluctuate There is a tendency today you buy this price, today shoot up double price. There is a possibility So that's why EPF, life insurance, they are classified as long-term funder. Whereas like general insurance, they are short-term. Because say for example, car insurance, and also house insurance, fire insurance, the chances people get accident or the house get burned is actually quite frequent, quite normal, because nobody know what will happen in the future So that's why in terms of their payment and compensation is quite uncertain, unpredictable. When anybody buy car insurance, the insurance company cannot predict one. This fella look at the face, don't know when we have a accident. You cannot predict because nobody can predict unless you are the god So because of that, their payment and compensation timing is always cannot predict an uncertainty. And because of uncertainty, they will choose more to invest in short term because short term is very liquid. In case you have accident, you want to claim, then I can quickly sell my shares, sell my REITs, then I got the money to pay the compensation to you. So that is the reason why they will choose more to invest in terms of short-term investment rather than the long-term investment. Then for the bank also quite similar. Most of the bank they are short-term rather than long-term. Okay. All right. So remember, do not confuse yourself between the funder and the borrower. That is the first thing I want to inform you. And then second thing, remember when you are answering the development funding topic, always remember to explain, to talk more from the developer perspective rather than the investor perspective. Okay, so any question? Any questions so far? Others, you all okay or not? Can or cannot? Okay. Wow, suddenly so many students already. Okay, any question? Still got time. If you have any question, feel free to ask. Okay, so since no message pop up, then all right. So that's it for today class. So remember to scan your attendance. Okay, thank you class. I will see you again next week.